For quite some time now, the US has outperformed other major stock markets around the world. And before we want to explain it all on a handful of giant tech stocks, the US still outperforms when each stock is weighted equally. As a share of all of the world's stock markets, the US sits currently at a whopping 40%, with no other country or region even close. The leading internet and consumer technology firms are overwhelmingly American firms. The US has a huge domestic market, and as a net energy exporter, more protected against energy shocks, unlike Western Europe, as well as having more favorable demographics compared to other rich countries. So there's been many articles and people saying that compared to the US, European stocks looks cheap. There's a so-called historically high pricing gap between these two markets. This means that when looking at stock prices in relation to company fundamentals like earnings or revenues, in the US you need to pay more. Now, as a Swedish person, this all hits a bit close to home. So I wanted to do some digging into this. So I used the website called koifen.com to get most of my data. It's not a sponsorship or anything, I just like their product. It's kind of like a cheaper version of Bloomberg. If you don't want to spend any money at all, you can check out my video how you can turn your Chrome browser more into a Bloomberg terminal, and I will link that video in the description. We're going to look at two broad US and European ETFs. Looking at the price to earnings ratio using earnings for the past 12 months, I calculate the US to be around 31 and Europe at 18. Now, one thing I want to emphasize before going forward is that pricing multiples are not valuation. Just because a stock is trading low compared to its earnings or revenues, that does not necessarily mean that it is a bargain. Because that low price can be completely justified when looking at other information like the company's growth outlook, the riskiness of the business, how efficient the company is deploying their capital, etc., etc. Now back to our example. So regardless if you are looking at fundamentals for the past 12 months or analyst estimates for the next 12 months, no matter how you twist it, US has higher pricing multiples. So what can explain this gap? So a common explanation is that the US market is concentrated into technology stocks, and these stocks tends to have higher pricing multiples. To see this, we can break down the sector allocation for each market, starting with the US. So it is true that US has a large concentration of technology stocks, about 1/3. The concentration in one sector is not a new thing. For reference, here's how it looked like more than 100 years ago. And other markets have sector concentration as well. Looking at Australia, for example, if you try to pick a stock, it's probably A-. Looking at Europe, their ETF is more tilted towards financials and industrial companies. This can be clearly seen when combining the two pie charts into one diagram where the US allocations are ranked in descending order. So why does this matter? Well, for starters, pricing multiples differ from sector to sector. Since as a group, different sectors differ in terms of growth outlook, use of debt, and return on capital, so we would expect some sectors to have higher pricing multiples than others. This you can clearly see when adding the forward-looking P ratio for each sector in the US. For example, technology has a 30% allocation, which we saw before, and a forward-looking PE ratio of around 33, while the energy sector has only an allocation of 4% and a PE of 12. Now we can see that real estate is the sector with the highest price-to-earnings ratio. Most of this comes from real estate investment trusts, or REITs. The reason for the high PE ratios is that US accounting rules allows these entities to record large depreciation expenses on their income statement. That's gonna lower the net income and inflate the PE ratio. So for real estate, the P ratio is kind of meaningless. So we will remove real estate from the analysis in both markets here. And as expected, this does not change much since the allocation to real estate was low to begin with. What matters more is that the US has a higher allocation to sectors with higher pricing multiples. Well, let's see what happens if we adjust the sector weights in the European ETF to be the same as the US one. Now the European multiples are getting closer, but there's still a wide gap. The reason is that we can see the same pricing gap within each sector as well, and the pricing gap within each sector is also historically high. Even if Europe were to have the same sector weights as the US, since the US has higher multiples within each sector as well, the pricing gap remains. So just looking at the difference in sector allocation does not explain the pricing gap. Another potential explanation is that the pricing gap is largely driven by a few large US stocks. So I wanted to redo the analysis I did before while removing the 10 largest US stocks from the analysis. And the pricing gap still holds even when removing the largest 10 US stocks. So to dig further, we can try to explain the variation in the pricing multiples using other factors, not just the sector or whether or not it's a US company, but try to include other factors like growth, profitability, and other fundamental data, and see which attribute is the most important in explaining the variation in the pricing multiple. One way of doing that is to use a regression model. And now we will gloss over some of the details here, but briefly, Finally, we want to investigate a linear relationship between a target variable, in school you called it y, and some set of attributes, x. The attributes that we use again are, is it a US or European company, which sector is it in, and other fundamental data like growth, profitability, and other financial ratios. Using a so-called lasso regression, we can remove some of the attributes to make the model more easier to interpret. We will be left with the attributes that are most important in explaining the variation in the pricing multiples. So let's do this for the forward-looking P ratio. So technically, I'm not going to use the P ratio, I'm going to use its inverse, so that's called the earnings yield. It's just that for the model, it's easier to interpret the earnings yield than the P ratio. And turns out that the most important attributes were how much cash does the firm hold in relation to its asset, how much does it invest in capital expenditures and research and development, again in relation to its assets, and also the size of the company, the market cap. Notice that we're trying to explain the earnings yield here. So a negative importance means that, for example, for cash holding, a higher cash holding will mean a lower earnings yield, which would mean a higher P ratio. So what is the takeaway from this result? So notice that the attribute, whether or not it's a US or European company, is deemed not important by this model after we include these other variables. The variance in the forward-looking P ratio is better explained by other variables than just looking at if it's a US or European company. So this could point to that if you were to do an apples to apples comparison of European and US stocks, the pricing gap we saw before would be narrower even still. So that in a bit weakens the claim that the European stocks as a whole are cheaper. And just a quick disclaimer, this model is not that good, honestly. There is lots of variations in the forward-looking P ratio that is not explained by this model. And also we're just looking at one point in time for all of our data. And I bet that if we were to do this analysis next year, the factors that is driving the variation in the P ratio at that time will probably be different than what we see right here. But I thought the result was interesting anyway, so I wanted to share it. Okay, that's it for this video. Thanks for watching. If you enjoyed any of my ramblings, please don't forget to press like. It will help me out a lot. Make sure to subscribe, and I see you in the next one.